So my next guest says to forget about soft versus hard landing. In the United States, it's all about the K-shaped economy of have and have-nots. So it is true that these can be considered the best of times and the worst of times. I'm going to bring in RBC, their new chief economist, Frances Donald. First of all, congratulations on the new role.
Thank you. Very exciting.
And I'm glad that you're here. Let's talk about, there's so many ways of illustrating this, but you have a chart here from a recent Federal Reserve report. And by the way, we use it on the show, so you'd be proud of me.
Good.
I've already used it, yeah. Let's talk about this for a moment. So you have high income, this is retail spending. High income up here, the lower income down there. You says this is your K right there.
There's the K, and that's the issue, is we're so focused on what is the total American economy doing that we're missing the point, scratch below the surface in the U.S., and you're going to find there are hard landings, there are soft landings, there's huge divergences. For American consumers, high-income consumers are feeling really good. They're spending just like the Federal Reserve showed, but low-income consumers, very negative, struggling, no excess savings left, high food costs, high rent. Their economic conditions are just not looking the same. And when we talk about the soft landing that seems to be appearing, we're not doing justice to the American people who are feeling a very different economy, especially those who are low income.
You know, I love that you're saying this. I can't get many economists to talk about this because they all use the aggregate data. So this could be 20% of the people with $1 trillion and 80%, and they take the whole number and say we're all doing great. But here's what scares me even more. Policy is based on aggregate data.
That's right.
So do rich people have to start hurting before there's relief for non-rich people?
Well, that's the challenge. And so if you're an economist or you're looking at markets, you have to focus on the aggregate. And if you're the Federal Reserve, you have to focus on the aggregate because it's the economy as a whole that's going to drive inflation. So it's not wrong to look at the total story. It's just not doing service to the depth of...
But can someone invent these tools? Because they tell me all they have is a mallet, right? Can someone invent more finite tools to go... There's got to be a way somewhere on the horizon. Otherwise, think about this. Where we are now is the reason to keep interest rates high. These high interest rates actually fuel the wealth of the folks who don't need it anyway. In the meantime, that bottom group you're talking about, they're paying 23% interest rates.
That's exactly it. Now, there is a tool, Charles. It's fiscal policy. Fiscal can actually go and target specific groups much more than monetary policy. But there, too, we have a problem because we are hitting up against some of these record levels of debt.
Right.
And there is not a lot of flexibility. Now, meanwhile, under the surface, we have the top 20% of Americans fuel 40% of spending.
Right.
So this economy as a whole can continue to chug along, look like this so-called soft landing. We don't actually need those bottom 80% of Americans to spend for it to look really good on the surface. But unless we actually pay attention to the underlying details, we're going to get confused with the economic data, which is sending different signals and showing different types of confidence depending on which segment of Americans you're looking at.
And then, of course, the same thing with corporations, right? Large CEO confidence going up. Small businesses going down. And of course, these big businesses, they have a lot of access to D.C. When you start talking about policy, that somehow still seems to benefit them more than small businesses. So let's talk about the U.S. economic conditions for a moment. U.S. growth will be uncomfortably slow. Several segments are operating in recessionary type environments, and the odds of recession are still higher than in standard periods. But you're still not going to say recession, though, or at least not a textbook recession.
A recession is 2 quarters of negative GDP, and we're just not likely to get that in this type of environment, especially because government spending is so high. It's also atypical. Usually we see huge levels of government spending in recessionary periods. Now we're seeing it in good times. That's keeping a floor under growth. But again, it doesn't negate that there are areas of this economy that feel really tough for a lot of folks.
Well, so why in the past, I mean, we've got a wartime economy right now. We're not at war. And we just posted the third biggest deficit in history. How come there was these rules about not doing those kind of things during peacetime, during great times for the economy? And why do you feel like those rules are just being ignored or erased right now?
Yeah, economists don't have the answer to that particular question. But when we see this situation arise, we can't help but get a little bit nervous. Now, a lot of folks will say there's going to be some big event. I'm less worried about that. Remember, the Treasury market, most liquid asset that we have, lots of demand for U.S. Treasuries and U.S. dollars. What I'm concerned about is that looking ahead, even if it's several years ahead, stock market not focusing on that, this is not a government that continue to spend at the same level it's been spending. There's going to have to be a pullback. And at that point, call me old-fashioned, you spend all the money in your piggy bank, the rainy day comes, you got a lot less to buffer the next challenges ahead.
You talked about an event, right? So I've got some of the problems with our fiscal path. What if there's no event, but today yields are going through the roof? What if bond yields don't come down the way everyone has assumed they would come down? What if some of these other things, maybe not a cataclysmic thing, but combined, we don't get that sort of normalcy that we normally would with a business cycle?
Well, that's a challenge for the Federal Reserve as well. So they may be looking at areas of the U.S. economy that need more support, but they can't lower interest rates because the economy as a whole, fueled by government spending, is still really strong. So what concerns me here is that there are three big contributors to large government spending right now. It's defense, entitlements, of course, but net interest payments are rising.
It's more than defense now,
exactly.
Isn't it? Yeah.
So I think that economists and taxpayers would really prefer if government money was going towards bridges, not paying U.S. Treasury holders their interest. So the quality of the federal spending also declines in an environment where you're paying more towards interest. As an economist, I don't like that too much.
Yeah, and by the way, as a citizen, I don't like that. And it's ironic that the richest folks are because we always talk about the $1 trillion in interest. The rich folks are getting that trillion, and they go and spend, so rates stay up, you know. Real quick, 30 seconds to go. The Economist had this thing. They had a bundle of buck dollars with a rocket ship going to the moon, right? It's always weird to me when the Economist or FT start to say America's doing great, or, you know, as a warning to us. What's your greatest warning right now, do you think, with respect? We know how great we are, but we cannot be fooled by the fact that it's preordained and it always stay this way.
Well, some of this I agree with. So America is standalone right now in its exceptionalism. We talked about the K-shaped economy inside the U.S., right, but the top of that K globally is absolutely the U.S. But if we continue to rely on huge government spending to fuel this economy, that runs out of steam eventually. This is a big structural problem, but it could get priced in. We could see that bond market focus on it a lot more. My big advice, though, my big concern is if we just look at those top-line retail sales and GDP numbers, we're not going to get the American economy story right. Policymakers need to watch that. I think investors need to watch it too.
Peel onion a few times.
That's all right.
That's why we have you here.
Nice to see you.
Thank you so much. And by the way, congratulations again.
Thank you.
All righty.